Good morning. It's 10:08 a.m. Eastern Time, Thursday, May 2nd. This is Richard Pawson, and this is the macro portion of the report that we normally update once a month. Today, we found some news on the jobless claims as the lowest in 5 years. And this particular chart I found on Barron's.com, because it's done by Econoday, and it just shows the jobless claims down sharply, and then the 4-week average is turned down. This can be a very volatile business statistic, and it does upset the market sometimes, and you just kind of have to be brave to look at the bigger trend and not get caught up in some of those volatile fluctuations, unless, of course, you're a very short-term trader. But at any rate, the trend has been down for a considerable amount of time now. We continue to work lower on the jobless claims. Now, this chart is also found on Barron's.com, Econoday. It's actually a chart of the Bloomberg Consumer Confidence Index. And this is very similar to, the consumer confidence. And note, throughout the 2000s, basically, people were not that all optimistic of the future, which I find rather interesting. But notice that in 2012, they became just as negative as they were in 2009. And I've seen some other studies coming out that are suggesting the stock market is going to do great by going into 2014 because this particular indicator was so negative in 2012 that people were so negative. Pretty interesting as some of these other studies, what they're suggesting. But at any rate, you can see they at least brought it back to that same low or lower. I can't particularly tell on this chart. But notice this run-up. Even though it's been choppy, they had some problems in mid-2012. Got nervous, the economy was going to fall apart, and now they're doing better, and yet here we had PMI news this week of the economy's not doing so better, but the consumer's actually feeling better and is now at a 5-year new high. The trend is up from 2012, the trend is up from the recession, the consumer is improving and feeling better of what's going on in their lives and what they think is going on for the country. In other news today, we found that U.S. productivity was on the rise. The jobless claims were at a 5-year low. The trade gap was down a bit. That may be a sign we're picking up on exports, and we need that, and a lower dollar can assist with that. The ECB cut rates, which on one hand is negative because it means they're still concerned over the recession or whether they're getting anywhere. On the other hand, it's a positive, meaning they're trying to copy the rest of the world, print money, try to put a floor in, try to turn things around. And then, of course, the news of the Bloomberg consumer comfort looking better. Okay, this is the ISM PMI standing for Procurement Manufacturer Index. And it's a very good indicator of the economy. If it's below 50, the economy is contracting, shrinking, it's losing. If it's at 50 or higher, the economy is growing, expanding. You can see that it's rather slow and it's declined. It peaked in February, and it declined by a large amount in March, and then a little less amount. It kind of slowed its downward speed here by April, but nonetheless went lower to 50.7. This means the economy is just crawling now, okay? But you have to be a bit cautious with this indicator. If you look back in 2004 to 2007, the indicator was saying the economy was losing ground. In reality, the economy was bigger and faster and better than ever, albeit on the real estate side, by 2007, it was ready for a crash. But what this is a rate of change kind of study, in my opinion. It has that characteristic. So if you have a recession, like the Great Recession, and beat this indicator up like it did going into 2008, and there's another company that has another version of this where they beat it up into 2009, actually, and then turned it around. At any rate, if you do that, all you have to do is start a nice recovery out of your recession, and this thing explodes. So it kind of implies, at first, economy is actually better than what it really is. And then when it eases back, if you're not cautious, it can make you feel negative about the overall economy. So what you have to do is just look at the amount of time it's spending at 50 and higher, look at the fact that it's still up from the 2008-2009 recession low, and say, hey, the economy is still growing. Now here's some interesting things we've come up with. A 3-year cycle top occurred in 2011. A 3-year cycle basically tops out every other year, but that's an oversimplification. It gets more complicated than that. And it bottoms the years in between. So we had a bottom in the recession, a top, a bottom, and it should have been up into 2013, if not into early 2014, and it may still do that. But working against it was this new low coming down in mid-2012, and it even threw me off. Normally, I bet against this indicator if it's bearish, and I win. That time I got nervous that yes, things are going to fall apart, and I got sucked in. Unfortunately, in about two months' time, I turned and said, no, get bullish stocks, get bullish economy. And if you look at that Bloomberg consumer confidence, the consumer got sucked into it as well. What that is a warning of maybe another cycle downtrend. So what I think occurred is the PMI slapped back up to February and topped for a 3-year cycle. And interesting enough, in 2011, it topped in February, I believe. The trend is down, and it may be down in early 2014, which would not be a good thing, but the odds are so low for 2014 that we have to consider the real bottom as 2013, like 90% probability of bottom 2013. In addition, what we've learned is that this 3-year cycle can bottom right here, right now, as of the April rating. So this may mean that in May, or actually June 1st, when we learn of May PMI, it'll actually be up some. So I'm a little suspicious that we're actually already going into the 3-year cycle bottom, and this entire 3-year cycle from 2011 to 2013 just doesn't matter. And ultimately, it's going to trend higher into 2014, maybe to 2015. In fact, it should trend higher into 2015 according to this. Now, what might be a little bit different but still okay is this really wasn't a 3-year cycle top. Maybe this really wasn't a 3-year cycle bottom. It's just a pullback. And all that's going to happen is it'll rally for this year, but it could top out this year to early next, more likely early next. Both scenarios then imply we can have a turnaround this year, and 2014 can be a better economy. It's just one scenario says it's going to be better all the way to 2015 and much better than we'd normally expect. Very interesting setup. Now, I'd like to point out, while I'm moving charts around, there's a study out there that says when the S&P 500 is up for 6 months, buy it, hold on it for 10 months, and it wins 100% of the time. I don't know how true it is or whether it works again, but the S&P 500 was up for 6 months. Well, if the stock market's going up for the next 10 months, why wouldn't the economy go up? Okay? In addition, there's another study of a contrarian indicator going back decades as well, and it's so extreme that some people are forecasting a 24% hike in the stock market from now into May of next year. So it's a similar kind of study. This study is where we take a cumulative study of that PMI, and it filters out some of the fluctuation during the year and during the decade, and it allows us to concentrate on a 9-year cycle, which is a very important boom-bust cycle, because when it bottoms, there's a recession. We get a recession once a decade, once for every 9-year cycle. So we had a recession, a boom period, a slowdown and recession period, and a bottom, and now we're in the boom period. The forecast is that normally the boom period lasts 7 to 12 years. The forecast is the economy is going to grow to 2019, and then we'll have a recession. So that suggests that really this poor PMI action we've seen here in the last couple of months is either just normal fluctuation and correction during a year that could still be a good year, or it's just a pullback for a 3-year cycle, and then you're just going to see better PMI, better economy anyways, inside of that much larger uptrend going to, say, 2019. And let's wrap it up with this study of the unemployment rate. Unemployment tops out every 9 years. It's actually about an 8 to 13 year cycle. It bottoms about every 9 years, 8 to 13 years. And what we're saying is, yes, the unemployment rate is down into 2019 in line with what we're forecasting for the economy. So the bottom line is the PMI basically is not going to do that well for the rest of the decade, but the economy is going to do much better than the PMI implies, and it's all good. So as long as we stay over 50, or if it dips below 50 but recovers fairly soon, basically everything's going to be fine. The economy is going to continue to grow, and my guess is we're going to have some positive stock market and commodity markets and positive real estate. So stay the course. We're bullish. Thank you.